Welcome to Market Catalyst. I'm Julie Hyman. Here's what we're watching today. First, we'll discuss the economic outlook for 2026 as investors prepare for the next read on inflation. Plus, could higher unemployment lead to a higher stock market? We'll have more on that ahead. And we'll discuss the future of Berkshire Hathaway under Greg Abel as Warren Buffett prepares to hand over the reins. Let's take a look at the major averages here today. We're sort of in between our two economic data days, and we've got a mixed picture for stocks again here. The Dow right now is up more than 200 points, about 0.4%. The Nasdaq very little, or the S&P little change, I should say, and the Nasdaq's down about 0.25%. We continue to watch what's going on in the bond market, and we're going to talk more about the relationship between bonds and stocks in a moment. But you see right now the 10-year yield at 4.16%. The other asset I want to call out this morning as definitely something that we are watching is crude oil. Crude oil yesterday falling to the lowest that we've seen in years, but today rebounding a bit. We're going to talk much more about this in just a few moments. But digging into stocks a little bit more, first of all, I want to take a look at the groups that are moving within the S&P 500. And there in the pole position is indeed energy stocks bouncing back today, along with those oil prices. Financials, real estate are doing well. Also, tech is down the most here today. The XLK utilities kind of neck and neck with it. But just want to zoom in on one stock in particular that has been troubling for the market in many investors' minds. Remember today, the Financial Times reporting that Oracle, which had planned on a data center development in Michigan, had run into trouble with debt negotiations, funding negotiations for that project with Blue Owl. Again, the Financial Times reporting that the shares are down 4.4% right now. If you look at this year-to-date chart, the stock is still up year-to-date, but going back to that chart for just a moment, we are now seeing it down some 40% from where it was, where we saw the record high for Oracle. So we've been seeing that sell-off quite a bit, but we don't see those jitters necessarily spreading elsewhere in the market. Right now, we actually do have NVIDIA trading lower. There was also a report today that Amazon was in talks to invest $10 billion in OpenAI and have OpenAI use Amazon's chips. Amazon up about 0.6%, NVIDIA and Google trading down, Broadcom also coming under some pressure today. Let's take a look at the economic backdrop for all of this and for next year. Stubborn inflation, rising unemployment, jitters over the AI bubble. They're just three pressure points that have weighed on the U.S. economy in the second half of this year. My next guest is looking ahead to 2026, and he sees the U.S. economy gathering some strength, finding its footing later next year. I'm joined by Seth Carpenter, Morgan Stanley Chief Global Economist. Hi, Seth. Great to see you.
Hey, Julie. Great to be here.
So let's talk about what that sort of trajectory and rhythm of next year could look like, because as you know, there are a lot of questions about how things are going to play out, both in terms of sort of the inflation cadence, the labor market cadence. So I guess first let's talk about the first half of the year and how you see those two elements playing out.
Absolutely. So right now, we're at the end of 2025, obviously, and we think we are in a bit of a soft patch, particularly, as you pointed out, for the labor market. And this is a point that the Fed's been stressing as part of why they've been willing to cut interest rates despite inflation being above their target and in fact going higher. We think that continues. We just got this week some of the sort of overdue labor market data, big hit in October that I think was reasonably expected, rebound, but still, flying pretty close to zero, not quite at zero, but pretty soft. We think that's likely to continue for the next couple of months. Spending had been inconsistent, but showing some strength at the top end of the consumer spending, showing strength in terms of business capex for AI, but again, a little bit patchy as well. We think there is real momentum there, but for Q4 of this year, so right now and into the first quarter of next year, we think we're going to be in a bit of a soft patch. Some of that is, continued drags coming through with tariffs. People like to think that tariffs are only in the rearview mirror, but the experience from 2019 tells us that it can take a couple of quarters before those drags start to work through the economy. If we look at manufacturing employment that get hit hard with these tariffs on intermediate goods and capex, that's struggling a little bit. So we do think we're in a bit of a soft patch right now, but the momentum from top-end consumer is still spending, the momentum from the continued flow of spending on AI CapEx, we think that's there. And so once the drags start to fade after the first quarter, gradually we think the economy will start to pick up. Does that mean a booming labor market? Probably not by historical standards. I mean, we're still, we have seen in the past couple of years lots of months where we're printing 200, 300,000 jobs per month. I don't think we're going back to that at all. But we don't think as a base case we're going into a situation where job losses are going to become the norm either.
So for the balance of the year, Seth, you and your team forecasting growth for 1.8% by the time we get to the fourth quarter. But you also say, because you guys, this note looking at 2026 looks across the globe, but you say the range of potential economic outcomes is widest for the U.S. In other words, like, we could be here or we could be here. Like, what are some of the determining factors on why that is so wide?
Absolutely. So take some of where the strength in spending has been, top end of the consumer distribution and business spending on AI. The spending that's been going on has really been too strong if you compare it to where the labor market has been and where job growth has been. One version of the world is the real signal is coming from spending, not the labor market. And so maybe, just maybe, the labor market is going to catch up to where spending has been, and we are going to see a bit of a boom there. I could see that happening. It's for us an upside risk scenario. Another upside risk scenario for us is that all of the work and hype on AI starts to bear fruit sooner than we think. Now, we think there is some real there. We do think productivity across the economy is going to gradually start to pick up over the next few years. But what if we are too pessimistic and it really comes in like gangbusters? That could give you a lot more growth with still pretty tepid labor market. And so I think there are two versions of the world where the economy could outperform our expectations, either because demand just stays a lot stronger and it pulls the labor market with it, or because the supply side, the productive side of the economy is much stronger than we think. On the downside, though, and this is what the Fed, at least some of them, are saying that they fear, job creation's weak. The unemployment rate has ticked up. We know that the unemployment rate got up to 4.6%. What happens if we transition from this no hire, no fire economy to businesses going, well, my non-labor costs like tariffs are still there. They're really high and consumers are getting more sensitive. I can't do anything about it. I have to get into a regime where I'm starting to cut costs, where I'm starting to fire people. Well, that type of inflection point could actually start to build on itself. And so I do still see a scenario where a recession could happen. Now, it would probably be a very mild recession. Household balance sheets are borderline bulletproof, especially for the top end of the income distribution. A lot of the corporate sector's got a really healthy balance sheet. So I don't think this would be a disastrous recession. But this no hire, no fire labor market, that's a very unusual place to be historically. And I don't see how you can rule out the possibility that we tip to the downside. So when we did that report, thinking about the outlook for next year, two versions of the world where the U.S. economy just outperforms our baseline expectation, which is pretty good. We're constructive as the baseline, but we could see a couple ways that it could be even better. But I don't think anyone should ever get so complacent that you ignore the possibility that things could actually get worse.
Yeah, I mean, the last couple of years have taught us a lot of lessons in all of these regards. So it's good to hedge your bets. I want to dig a little bit more deeply into the sort of some of the AI points that you made just then, and also that you guys make in your note, because I think this is such an open question, something that economists are grappling with, investors are grappling with, how this is going to play out. So the first thing I want to look at, you guys have a chart here of non-residential fixed investment and kind of like how this is, that's the AI productivity one, but you have one where you're looking at kind of how the investment is going to go over time. So over the next few years. So what does this say to you about then how it transmits into the economy and how significant it's going to be?
Yeah, so I think there's a lot to unpack there. Yeah. First, historically, in the pre-AI boom era, most of business fixed investment spending sort of follows along with where the overall momentum of the economy is going. And this year, if in the past year or two, if you were to strip out the AI part of things, you don't get that much going on. And so AI CapEx really is helping to pull things along. What we think is going to happen is that flow of spending is going to continue. The contribution to GDP is meaningful. It's there. It's probably not as big as some people say. I mean, I've seen reports where people say if it weren't for CapEx on AI, we wouldn't have had any growth this year at all. I think that's overstating it, but nevertheless, it's a really solid component to where spending in the economy is going. I think the real question is, how much can that momentum sustain? And then do we start to see on the back of a continued expansion after we get past the soft spot, if CapEx spending broadens out across the economy? Now, in terms of AI filtering into the economy, there are lots of ways there. There are people who are so ready to believe that it's a transformative technology right now that they're worried about the entire labor market collapsing. That I'm less concerned about. Some of these data centers, they're lots in the news. They're going to take years to be completed, and so I think to unleash the complete power of AI and the complete transformative power of AI, that's still years off. But businesses everywhere are finding use cases right now. Even without all of the data centers up and completed, they're finding use cases now to become more efficient. How much does that boost productivity? I think that is an impossible question to answer with precision, but I feel very highly convicted that it's greater than zero. And so we're building into our baseline a couple tenths of extra productivity growth from AI. Doesn't hurt that labor costs have gone up over the past 5 years, and so businesses have an incentive to economize on costs as well. But I think those forces coming together really should give you at least some spark of optimism that productivity growth could be turning up a little bit.
Well, and Seth, it sounds like that your outlook for the unemployment rate next year isn't factoring in like mass layoffs related to AI.
No, that's right. I think, again, it's very easy to paint sort of extreme pictures. I think there are definitely people who are in an almost apocalyptic mindset about what AI could be doing to the labor market, and I'm just not there yet. Lots of studies about how much the unemployment rate for young people has gone up over the past couple of years. But the aggregate unemployment rate has also gone up. We did not that long ago, a couple of years ago, have an aggregate unemployment rate of 3.5%. Now we're at 4.6%. Well, new entrants into the labor market always bear the brunt of a slowdown in hiring. And so if you sort of compare how much aggregate unemployment has gone up to how much youth unemployment, say 20 to 25-year-old unemployment has gone up, it's not really screaming that this is a fundamentally new era. You are seeing that younger cohort's unemployment rate rise because the aggregate unemployment rate is rising, because hiring is slowing down overall. I don't think you can say AI has now fundamentally changed the labor force right here and now. I think it's a much slower process where there are going to be some benefits, and we can get more output from the economy with the same labor market, as opposed to thinking, gosh, we're just going to keep producing the same amount and all of those jobs are going to get destroyed.
Fingers crossed, Seth. Thanks so much for joining us. Good to see
Absolutely.
you.
Bye-bye.
Let's turn to the oil market, because oil is rebounding after hitting its lowest level since 2021. Crude prices did drop below $55 a barrel on Tuesday, and this coming as President Trump is ordering a blockade of sanctioned oil tankers entering and leaving Venezuela. Yahoo Finance's Jake Conley has been tracking all of this. Jake, you were just yesterday we were talking about the prices the lowest since 2021. And now President Trump kind of changing the calculation. What effect does this have? Talk us through it.
Yeah, so you look at prices this morning. WTI, the US benchmark, is up about 1.3% after a 2% jump. Brent, the international benchmark, same thing. Clearly a reversal from a 3% nearly drop yesterday. Inciting incident here is the blockade. Whether it's going to have an impact, I think is going to have to play out over the next few days. But you look at this in the US, obviously a bit of a jump on US oil prices, but Venezuela only accounts for about 1% of the US's oil imports. So really not a big factor in the US market. Globally, it's also sitting on the biggest proved reserves in the world. It's not a huge global exporter though. So again, whether this is going to have a long tail, I think is hard to say.
And do we know of the tankers coming in and out of Venezuela, like how many of them are sanctioned by, when we talk about sanctioned, we're talking about what, Russia primarily, or what?
These are tankers that have been involved in the Iranian trade, some with Russia, some with China. It kind of depends, but you're looking at a bit over 100 roughly for the amount of tankers who are probably going to be affected by this. In the last couple of days, we have already seen 4 tankers headed for Venezuela, turning around in the middle of the ocean and going back. One of those was sanctioned. 3 of them were not. So what you're seeing is even companies who aren't covered under sanctions are already saying, I don't know if I want to take this risk of ship, cargo, crew. Maybe it's not worth it.
But to your point, like the broader, and you and I have been talking about this in recent days, the broader supply-demand picture is not positive for oil prices. It's good for people driving and wanting lower gas prices. So how do we figure out whether this fundamentally shifts that picture? And obviously we don't know for how long either.
Yeah, this is why I say it's hard to say what the long tail of the Venezuela news is going to be, because the dominant market narrative, Julie, you're right, is that huge wave of oversupply that's coming down the pipe. The IEA has that pegged at about 3.8 million barrels a day next year, which is going to push prices, if you look at street picks, down into the 50s. If OPEC doesn't stop producing, maybe even down to the 40s or 30s, which would have a real hit globally and here in the US on shale producers. Whether the Venezuelan news really has an impact is going to depend on what comes next, because this is an aggressive step forward. A couple of weeks ago, the US turned back a crude tanker heading to Venezuela. A week ago, they seized one. Now with this blockade, whether this has that long tail, again, is really going to depend on what this signals to the market about US aggression. But that dominant narrative is going to remain the oversupply and just this huge supply-demand imbalance we're looking at.
When we see an uptick, I mean, it's just one day, but if we see an uptick, how quickly does that translate into U.S. prices at the pump? Like, what should we be watching for there, or are they going to remain pretty low?
It's hard to say exactly how fast it'll show up, but if you look at gasoline prices in the U.S., the oil price makes up about 40 to 50% of that. So any meaningful jump will have an impact. How quickly that ripples out versus how much the market kind of adapts and says, okay, there's no tail here, prices are going to go back down, very hard to say. But it could have an impact, especially if prices stay a bit inflated. However, you talk to any analyst on the street, pretty much unanimously, they're looking for prices to drop in the next few months. So what the pump impact is, very hard to tell right now.
Yeah, we'll just be watching as those events unfold in Venezuela. Thanks, Jake. Appreciate
Thanks, Julie.
it. Coming up, why my next guest says unemployment and stocks will continue to move higher together. Stay tuned. You're watching Market Catalyst. November's unemployment rate ticked higher to 4.6%, and stocks fell. But the jobless rate has been moving up throughout 2025. And stocks have rallied. That's a trend our next guest says will continue into 2026. Joining me now, Michael Kantrowitz, Piper Sandler Chief Investment Strategist. Mike, it's good to see you. So
You too.
You would think a higher unemployment rate wouldn't be good for stocks, but is this because we're in this like backward sort of bad news is good news scenario because it might mean the Fed's going to continue to cut?
Yeah, I think that's the colloquial way that investors are thinking about it. But I did think that higher unemployment is bad for stocks. It seems very reasonable. However, if you go back and look at the data in periods from basically the early 90s all the way back to the early 50s, so there were 7 times where the unemployment rate went up during those decades, and in every one of those periods, as long as the 10-year yield was falling while unemployment was rising, the stock market was going up. And obviously we didn't see that in 2001 and 2 or 2007 and 8. And the most recent memories shape people's expectations. And so it's not something we've seen a lot recently. But if you go back in history, and what's important about those periods is, like today, those were periods where, like you say, bad is good, or I guess a more quantifiable way to make that point is that interest rates and equities were negatively correlated. Why was that the case? Because like today, there was a lot of anxiety around inflation and whether it's going to go up and all the problems that people are focused on with respect to interest rates potentially going up, from everything from housing to the budget deficit in the US government. So we are seeing something that we've actually seen 7 times in history, which if you look at how many times the unemployment rate's gone up since 1950, it's been 10 times. So it's actually arguably the norm, not the exception.
But something that's happening this time that is the exception, not the norm, is that the Fed's been cutting and 10-year yields have been going up. And as you said, as long as the yields don't go higher, right? And I know that's something. So that's like sort of your caveat, right? That's something you're watching closely.
I want to push back against that. I know I've seen people make these charts from the first cut in September of last year. The 10-year yield is up. Of course it is, because we're at 3.6. I think that's a bit too rigid a study, because the reality is the market started pricing in the Fed cutting back in May of 2024, and interest rates declined for 5 months before the Fed even cut. Obviously, again, markets are, unless we believe the markets aren't forward-looking or real-time ahead of the Fed. So I think there's a bit of subjectivity bias in that starting point. The reality is that the unemployment rate started going up in the third or fourth quarter of 2023, when interest rates on the 10-year were over 5%, mortgage rates were over 8%. So I take a little, I take exception with that idea.
Fair. So let's talk about 2026 though. When it comes to yields, do you think there is a risk that yields push higher, or at least remain stuck where they are, because there isn't a lot of not just Treasury supply, but corporate debt that's expected to come to market next year?
Yeah, well, there's a lot of things, there's nothing been debated more than where the 10-year is going over the last 3 years. And the reality is that, again, broadly speaking, it hasn't gone anywhere. We've been bouncing between, roughly, we hit a low as 3.6, we hit a high of just over 5 in 2023, but we've been averaging a 10-year with, around 4.4, 4.3 over the last 3 years. And what I see is that is explaining where yields are going is the labor data. Bloomberg has a great labor surprise index, which has a bunch of different labor data points like claims and ADP and payrolls, and nothing more than that has explained the direction of changes in the 10-year. So when we go back in that first Fed cut a year ago, when the 10-year was at 3.6, what also was occurring when the Fed cut is that the labor data actually started to improve in the back half, the fourth quarter of last year. The unemployment rate went from 4.3 back down to 4.0. The 10-year went back up 110 basis points. And this year, the 10-year's come down because the unemployment rate's gone back up. So to me, it's not the supply of Treasury issuance. It's not the budget deficit. What is explaining the direction of 10-year yields is very clearly the direction of the labor data and whether it's surprising or not. And what we've seen in the last, few months is that we've had weak labor surprises and the 10-years come down. And where the labor data go in 2026, and I think it's going to remain pretty sluggish, will determine, I think, where the 10-year goes. And therefore, again, I think the yields roughly stays here or probably goes even a little lower into 26.
And Mike, your target for S&P 500 year-end next year is 7150, which is higher than where it is now, but it's not that high, right?
That's not my target. That's our technician, Craig Johnson.
Oh, excuse me.
Does a target. Yeah.
Do you have a target?
No, I stopped doing targets about 2 years ago because the concentration of the index. I think someone who's covering NVIDIA probably has a better chance of getting the S&P target than a strategist. So, what I'm focused on really is positioning and whether the market's going to be broad or narrow next year. And, again, the last couple of years, if you had a really bullish target in the S&P, that doesn't mean that you had this broad-based movement in the equity market. So I do think the market will be up next year. I think multiples will remain fairly plateaued at these higher levels. And the implied earnings expectations from the bottom up sell-side analysts is about a 14% growth from earnings. So that implies the S&P, if we hit those targets, is up 14%. I think that's reasonable. The biggest risk to equities, in my opinion, is, again, if interest rates on the long end do move considerably higher. And again, I don't think that's very likely unless we see a shock from oil or the unemployment rate, really does a big turnaround and goes lower.
Okay, so and if you're expecting stocks to go higher, I know you looked at kind of what has been outperforming outside of the U.S. You point out value's been outperforming.
Yeah.
Inside of the U.S., what do you think is going to be sort of the winning strategy going into next year?
So with the unemployment rate going up for the last 2 years and interest rates coming down, from the highs in 2023, all of our forward-looking models of macro breadth are now starting to show improvement in 2026, suggesting that we're even going to see incrementally better housing data, and we're going to see better manufacturing PMI data, which has been under 50 or in contraction for almost 3 years now. And so if we see just a bit of an improvement in housing and manufacturing data, that should correspond with broader earnings breadth, something that's been lacking for the last 2.5 years, which leads to a market where more cyclical and value areas are likely to outperform. So that's the call we're making, that we're going to see a year of value leadership, and the incremental upside improvement in earnings is not going to be in the AI space or in the growth space.
So does it just mean that in relative performance terms, value sort of come, in other words, do you think AI stocks will be slowing down and that value will sort of rise to meet them? Or do you think that AI is going to underperform more meaningfully?
I think it's more of a relative game, but I think AI stocks are generally more expensive. And I think that's an area, as volatility around that story and uncertainty remains or potentially increases, you could see some multiple compression in those areas. So I still think the earnings growth is going to be good, but I think it could be offset by some multiple compression. Whereas in the value cyclical part of the market, think about transportation, housing, manufacturing, where earnings expectations are depressed and valuations are certainly lower. I think you can get the opposite, better earnings improvements in terms of expectations, and due to that, some multiple expansion. So I think it's a combination of earnings and PEs that are going to lead to relative outperformance.
Mike, thanks so much. Appreciate it. Good to see you and happy holidays.
Okay, you too. Take care, Julie.
Coming up, we're going to take a look at some of the top analyst calls on Wall Street and today's trending tickers. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke Topama. We're live at the NASDAQ here in Times Square. Let's turn now to some of today's top analyst calls on Wall Street. Today we're watching shares of Gap, Coinbase, Hyatt, and MGM. First up, let's take a look at Gap. Both Telsey Advisory Group and Baird upgraded the stock. Telsey Advisory Group upgraded the stock to outperform and raise its price target to $32. Now, the analyst said the retailer has seen momentum across its brand portfolio, with the exception of Athleta, which it thinks is still a work in progress. The analyst also said the company was able to successfully navigate tariff headwinds. While Baird upgraded the stock to outperform, it cited that Gap demonstrated positive momentum with 7 consecutive quarters of positive comparable sales overall. That was driven by both the Gap and Old Navy brands. Next up, we're watching shares of Coinbase because Deutsche Bank initiated coverage on the stock with a buy rating and a $340 price target. The analyst expects the company to benefit financially from the next stage of its evolution by leveraging its long-established solid market position within the crypto space into a much broader on-chain platform. Now, keep in mind, overall on the street, there are 24 buy ratings, 12 holds, and 5 sell ratings on the stock. Lastly, we're watching shares of Hyatt and MGM. Barclays upgraded shares of Hyatt to overweight based on accelerating organic unit growth and outsized luxury exposure, but downgraded shares of MGM to equal weight due to negative Las Vegas trends. Hyatt is well liked on the street, though. There are 14 buy ratings and 9 hold ratings on the stock, while MGM has 12 buys, 11 holds, and 2 sell ratings. Keep in mind, though, year to date, both stocks are up around 5%. Keep it right here on Yahoo Finance. We'll be tracking all the latest market moves and top calls throughout the session.
Now time for some of today's trending tickers. We are watching Hut 8, Jabil, and Coursera. First up, Hut 8. The former pure-play crypto miner is expanding in energy infrastructure. Hut 8 announced it is partnering with FluidStack to build an AI data center for Anthropic in Louisiana. Hut 8 signed a 15-year, $7 billion lease with FluidStack to provide 245 megawatts of IT capacity. The deal also has 3 5-year renewal options, lifting potential contract value to about $17.7 billion. Google is providing a financial backstop for the base lease term. Meanwhile, JP Morgan and Goldman Sachs are expected to lead up to 85% of project-level financing. Next, Jabil, the manufacturing company, out with earnings. The electronic parts supplier beating quarterly earnings and revenue estimates. It also lifted its fiscal year forecast. Jabil's results have been boosted by strong demand from artificial intelligence and cloud computing infrastructure customers. The stock is up about 60% this year. And finally, Coursera, the online education platform, announced a deal to acquire Udemy for $2.5 billion. It's an all-stock deal and will create a combined entity with a valuation of about $2.5 billion. The transactions received unanimous approval from both companies' boards of directors, and Greg Hart will continue as CEO of the combined company. He's CEO of Coursera right now. The deal comes at a time of slowing growth for online learning providers. Now, earlier, Coursera was actually lower following the deal. Right now, it's up 5.5%. Udemy up 24%. Coming up, Berkshire Hathaway after Warren Buffett, how investors should be thinking about the company in 2026 and beyond. We'll be right back. Berkshire Hathaway is heading into one of the most consequential transitions in its history. Greg Abel officially steps into the CEO role on January 1st, marking the beginning of Berkshire's post-Warren Buffett era. Yahoo Finance's Josh Lipton spoke to Jonathan Boyer, president at Boyer Research, about how investors should be thinking about Berkshire in 2026 and beyond.
Jonathan, it is great to see you. So let's start here, Jonathan. You said Greg Abel, you argue, will be much more hands-on than Buffett. What do you mean by that, Jonathan? And what would that shift actually look like inside Berkshire if it happens?
Thank you for having me. Warren Buffett is known to be a hands-off manager. He has a decentralized structure. Many businesses sold themselves to him because they wanted the autonomy to do whatever they want. And that's obviously worked out extremely well for Berkshire over time. However, by having this decentralized structure and not having management oversight, there's probably a lot of fat to cut. Mm-hmm. There's probably divisions that could be consolidated. There's many things that they could do to enhance profitability that Buffett just hasn't wanted to do. Buffett is the greatest capital allocator and the greatest investor of all time. He's not known as the best manager of all time. Greg Abel might be able to do things that he wouldn't or couldn't do.
What could Greg Abel do with that giant cash hoard? What would you like to see him do with it as a shareholder? As
a shareholder, I mean, the amount of cash they have is excessive. Since Buffett is going to be gone, he's the greatest stock picker of all time, I'd like them to de-emphasize the actual stock picking. I'd like them to start paying a dividend. Hopefully over time they do that. That might not happen right away, but it would be a nice thing. I would like them also to buy back shares. It'd be great if they could make acquisitions, if they could find them. Unfortunately, a company that size, it's hard to find an acquisition that's cheap that also moves the needle.
What do you think, Jonathan, Greg Abel can do to try and, as quickly as possible, sort of earn the street's trust? Like if he came to you, Jonathan, and he was asking you for guidance on that topic, what would you tell him?
Well, I would love for him to give me a call. But one thing I would like him to do is, he owns a fair amount of Berkshire stock, but all of that was bought when obviously Buffett ran it. To me, a great sign for Wall Street would be for him to buy an extremely large amount of Berkshire stock personally and really put his money where his mouth is.
As a shareholder, how much leash you want to give Greg Abel to prove his merit here? I mean, do you give him what's the time frame, Jonathan, for you? Is it 1 year, 3? Is it 5?
Listen, we're long-term patient investors. Buffett has created a business that can basically run itself. You want him to be a great steward of these assets. You want him to go in and manage them better. And I think after a 3 or 5 year period, you would be able to see, is he doing a good job or not? And I don't think you can judge anyone on a 1 year period.
You say here, the days of extraordinary returns are behind Berkshire. So as a shareholder, what would be a more realistic return profile, do you think?
I mean, I think over a 3, 5, 10 year period, I think it should be able to beat the S&P 500. I think, the returns have been massive historically. I mean, it'd be impossible, the law of large numbers comes into play. But I think it could be a very good long-term core holding for people. That's a good diversification away from the tech-heavy, S&P 500 and NASDAQ.
What have you been doing with your own position here, Jonathan? You've been holding steady, trimming, buying?
We've basically been holding steady. If for whatever reason shares dip because people are worried that Buffett is leaving, I would view that as an opportunity to buy more.
What are the negatives, if you can try and quantify them or qualify them, of Buffett leaving? He is the oracle. What do you think can't be replaced?
Him. I mean, he is the secret sauce. People love to do deals with Warren Buffett. He got the great deals during the financial crisis. But over the last couple of years, with the exception of Allegheny, most of the deal, they haven't done much, and the deals that they've done have not been good, which is partially a result of their size. And also that PE is much more involved than ever before. So I think he will obviously be missed. I wish he could stay CEO for another 10 or 15 years, but he certainly earned his retirement.
In your opinion, Jonathan, I'll get you out of here on this, greatest value investor of all time?
Absolutely, hands down.
How so? Why so? Explain that for us.
Because he's done this for a period starting in, I believe, the 50s and 60s up until today. I mean, the longevity that he has, the discipline that he has. He did it as a hedge fund manager. He's done it by investing in companies, buying back his own shares. He's just a fantastic capital allocator.
Greg Abel, big, historic shoes to fill. Jonathan, thanks so much for your time today. Appreciate it.
Thanks for having me.
And we're going to have much more on Berkshire Hathaway later in the show. Coming up next, though, the biggest themes that dominated ETFs in 2025. ETFs are on track for the highest year of inflows on record, with $1.28 trillion invested year to date. But of the over $13 trillion of total assets invested in ETFs, where exactly were investors putting their money? For a deeper dive on the biggest themes that define ETFs in 2025, we're joined by Christian Magoon, Amplify ETF CEO, for this week's ETF report brought to you by Invesco QQQ. Christian, thanks for being here.
Hey, good to see you, Julie.
I mean, I guess I don't know when the last time we didn't have a record amount of inflows. I guess I'm looking at the chart and it looks like maybe 2022 was not quite as strong, but like mostly it's gone up and to the right, in terms of the inflows into ETFs.
Yeah, I mean, it's a great industry to be in, and certainly for investors, there's a lot of advantages looking at ETFs versus other vehicles. I like to say ETF efficiency for tax efficiency and cost efficiency, T for transparency, and then F for flexibility. Those benefits from the ETF wrapper are just hard to ignore for investors.
Okay, so let's talk about some of the big themes that were affecting those inflows and where money was going. I know you were watching what was happening in the precious metals space. Obviously, gold itself, silver itself, were doing very well. How is that playing out with ETFs?
Yeah, silver and gold has been definitely a theme this year, with gold up over 60%, silver up over 120%. So we've seen strong interest in both physical silver and gold, as well as gold, silver, and mining ETFs. Some of the silver mining ETFs are up over 170%. We have one SILJ. So these types of rocks are getting a lot of demand. Gold's a little bit different than silver. Silver has a lot of future demand when it comes to electronics, data centers, batteries. So we think that's a really interesting area that will continue into 2026.
And then, of course, this has been an interesting year for crypto, right? Because it's sort of like there were almost two parts of the year when it comes to crypto, right? In terms of ETFs, enormous flows into crypto ETFs. But then, of course, we had the price come down a lot in the second half of the year. So what did that look like in ETFs?
Yeah, so tons of inflows really up until October 10th, when we've had this kind of crypto crash, and the market's really gone down to sideways since then. We've seen continued inflows and some new launches with some of the smaller coins, though not quite as big. I've seen a little bit more interest in crypto option income ETFs. These are ETFs that own Bitcoin or Ethereum, Solana, XRP, that write options on the crypto to generate monthly income. And we have a variety of those ETFs that Amplify, and we've seen increased interest as markets have gone down a little bit or traded sideways. You can get income along the way and don't just have to depend on price appreciation for your total return.
Interesting. Okay. And then, of course, those were almost small little themes compared to the last theme, which is AI, which, of course, has dominated the discourse and the trading activity this year. And there's also been sort of a profusion of new AI ETFs, like ways to play it. So what kind of stands out to you in that realm?
Well, everyone's interested in AI. As the year went on, we definitely heard from advisors and institutions. They're a little bit concerned about maybe how top-heavy AI was and maybe some of the cyclical nature of spending within the industry. So, we really thought that kind of taking some of the weighting off top names made sense. We have an equal weight approach, AIVC, an index-based AI ETF that actually was the second best performer this year in all AI ETFs. And again, it was because it took an equal weight approach, not only in security selection, but it equally weighted semiconductors, hardware, and software as industries within AI. And we think that prudent approach kind of ended up proving out this year. We think it's probably a prudent way to go into 2026 as well.
So talk to me a little bit more about 2026 and what do you think is going to be the big dominant theme or themes next year?
Well, I think, one issue is the midterm election cycle. Certainly historically, we've seen that be kind of a interesting year with a lot of volatility, maybe a correction here in the first half of a midterm year, but then a very strong historically second half or back half of a midterm election year. So we have that playing out, certainly with the dynamic with the Federal Reserve, probably loosening its purse strings, probably more towards middle of the year, also seems to be quite bullish. So I think if we looked at it, we're cautious about the beginning of the year, more bullish towards the end of the year. A lot of that is because of liquidity opening up and the election cycle. Maybe give us a chance to kind of refresh the market after 3 nice years. From a broad-based standpoint, we still think metals are going to be a great place to be. And I think we expect to see a crypto recovery going into kind of the second half of next year, maybe as close as the second quarter. We think also potentially Ethereum and Solana could disconnect more from Bitcoin. This move into stable coins and tokenization, these utility coins really benefit from that, where Bitcoin really needs to see liquidity open up. And again, that may be a second half trade, whereas utility coins, Ethereum, Solana, stable coins, tokenization could come early in the year and kind of boost prices sooner than Bitcoin.
A lot to buckle up for, Christian. We're ready for all of it. Thanks so much. Appreciate it.
Thanks, Julie.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets. Taking a look at the major averages here, we've got all three that are now lower by a pretty significant degree. The NASDAQ in particular is down by more than 1% here, so resumption of this tech-led sell-off for the moment. The S&P 500 off 2/3 of 1%. The Dow, the outperformer today, but it's still down by about 90 points. Now, I want to point out what's going on with Oracle. As we told you earlier, the Financial Times had reported that there were some delays to getting funding from Blue Owl for a data center project in Michigan. We reached out to Oracle for a statement, and they say, quote, the FT story is incorrect. Our development partner, Related Digital, selected the best equity partner from a competitive group of options, which in this instance was not Blue Owl. Final negotiations for their equity deal are moving forward on schedule and according to plan. Now, that statement, which has been out publicly, is not necessarily helping the stock. In fact, it is accelerating to the downside. As you know, there have been some concerns around Oracle in particular, and sort of the amount over time that it's going to be getting from OpenAI to fund these data center build-outs. So we're going to keep watching this story very closely. Another story we're watching, United Health Group. It is the worst performing stock in the Dow Jones Industrial Average this year. Shares are down more than 34% as the company deals with rising medical costs and regulatory scrutiny over its Medicare Advantage business. So we're taking a closer look at the company as part of our Down Bad series. Joining me now, Megan Fitzgerald, Columbia professor, Gregos Capital private equity investor, and Tenet Healthcare board member, former nurse. She's been in the medical investing industry for a long time. It's great to have you here, Meg.
You too. Nice to be on set.
So United Health is the biggest, and the biggest healthcare insurer, and it has been a turbulent time for healthcare insurers and for United Health in particular. So this year has not been a good one. What sort of has been the biggest challenge for United Health?
Yeah, I think, well, first of all, Fortune 5, one of the largest companies in the world, and I think it's important to note that they not only do insurance, they provide direct care. So they take full vertical risk of the patient. And I think medical costs, claims management, it just was a tougher operating environment, cuts in Medicare Advantage, and I think they somewhat lost their way on being able to manage some of these surprises when usually they're a bellwether to see where the costs are going. On a positive front, Q3 looked pretty positive, that they were getting underneath it, and they were guiding to say that they would be profitable and have a turnaround and have EPS growth this year. And so I think you're seeing the estimates come in where people are now seeing green shoots of that story. They've been here before. Remember, they started in 1974. They've been through numerous cycles of challenges in the market, and they've always been able to weather the storm.
I'm also curious about sort of public sentiment towards United Health. Of course, we are witnessing the trial of someone who killed a United Health executive that's been going on now. Public sentiment has not been great, but you're not usually, most people are not shopping around that much for their healthcare plan. So is that something that affects the business?
Yeah, listen, number one issue right now for Americans in healthcare is access and cost. Gallup has not seen it be this high in a long time. So with inflation, with all that's going on, healthcare costs are really troubling for patients. So some of that halo feeling definitely falls over to United Health because they're the health insurer. They're the one you have to buy your insurance through. And we're in the midst of the open market season right now where everyone's shopping, and they're not really seeing any relief on the subsidies. Congress can't get it together, although maybe this morning something's changed. So I think a lot of it is attributed to an insurer. That's not usually the group that you feel good about when you're out buying something.
Right.
And you have to not buy holiday gifts or, offset the purchase of a car or bills at home. It's a tough time for people, and I think they do share in some of that negative sentiment.
And I should say, United Health is the employer-sponsored plan here, so that's the one we've got by default. So Meg, what happens next year then? We've also seen not just United Health, but a lot of these companies paying out a higher percentage of their premiums to cover costs.
Yep.
So that's squeezing their margins. Does any of this get better in 2026?
I think so. I think we hit a nadir over the summer. I think right now United's 45% off all-time highs. CVS is up since the summer. United has been up since the summer. So I think we're starting to see light at the end of the tunnel, that they're managing. The medical loss ratio has come down for United. So they're really managing the book. And remember, they have multiple ways to win in terms of providing insurance, providing care. They have a pharmacy, they have a pharmaceutical benefit manager. So they have multiple ways to manage the patient. And for all intents and purposes, it looks like 2026 will be getting back to basics for United. Some have an 8% EPS growth. Some analysts are up over 20%. So I think what to watch on January, 27th, when they release earnings, is to see how do you reconcile someone that thinks it's 8% and others that think it's 20. So clearly, the market has a buy on United, and many feel you don't cut United out given their scale. I think we just run into a time where scale can be your friend, but sometimes scale can be complex for United, and I think they're working through it.
I want to talk more about the Affordable Care Act and those subsidies, and as they relate to UNH, but also just the broader industry. As you mentioned, there's some reports this morning that maybe Congress is figuring out, that we've seen some moderate Republicans join with Democrats to try to push through a vote on extending the subsidies.
Yeah.
What do we think? Is it going to happen, and how important is it that it happens?
Oh, I think something has to happen. So on the Republican side, you had an offer to maybe give $1,000 and work out some, type of alternative benefit option. And then on obviously the independent and Democrat side, and really the majority of Americans want the subsidies continued. And the raw math is if two people make $100,000, their benefit costs are around $7,000, and they were once $3,000 a few years ago. So in a time of inflation, that is really meaningful. The majority of the public wants the subsidies extended, which is why I think you saw 4 Republicans buck the trend this morning and say, we're joining the crusade. It's also a major voting issue. This is hitting people. It's personal, it's political, and it's affecting their lives. You could put off a car purchase, you cannot put off surgery. So I think they're going to have to come to some resolution.
And what are the implications for the industry of the extension of subsidies?
I think everyone wants these to extend. Nobody wants to have a patient go to the ER uninsured. We all pay for that. Everybody wants folks to have coverage. It's not so much about finding a physician, it's having coverage when you find a physician. And illness is growing. With a population getting older, people are having more illness and they're needing more care. And so having 30 million people not have coverage or have partial coverage, I think hurts all of us. That's not where I would focus. I would focus on waste and bureaucracy and administration. I wouldn't take a benefit away. It's very hard to take a benefit away.
And when you say you would focus on waste and bureaucracy, you're talking about like, how do we tackle this huge problem of medical costs being so high, which isn't good for us. It's not great for the insurers either, by the way, because they're the ones, who are paying out that higher medical loss ratio. So are there real efforts anywhere? Are there models across the country and various systems to try to do some of this?
Yeah, I think if you look at our system, we have $1 trillion in waste. Look at something like prior auth. There's like $300 billion in waste in prior auth. We all hate it.
So prior auth, just for people who haven't had to grapple with it, you have to have something done. You got to go to your insurer first and get that prior authorization.
Get the green light.
Why does that gum up the system? Why does that cost more?
Oh, it takes forever. You're in limbo, waiting for it to happen. Your doctor has to file hours of paperwork. Doctors in the U.S. do twice the amount of paperwork as doctors in all of our peer countries. So if you work a 12-hour shift, add an hour for paperwork. And the prior auth is, did I green light Julie tomorrow for a procedure? And we go back and forth. Sometimes we delay the procedure because we didn't get the prior auth. Turns out 80% of the time, the prior auth is approved. That's just a staggering stat, that it's a waste. It's $300 billion of waste. So I think with AI and what we call a shift left, trying to green light the patients up front so you can remove some of the bureaucracy around billing and prior auth, I think would go a long way, and everybody wants that. So I think right now the administration should look at targeting waste and bureaucracy, which is what everyone wants, versus removing a care benefit that is really going to hurt a lot of people. And I think you're going to see that come up in the midterms. This is deeply personal, and it's highly ranking now among U.S. voters.
Yeah, for sure.
Yeah.
All right, Meg, good to see you. Thanks
Always
so
good
much
to
for
see you.
coming in. All right, coming up, what Warren Buffett's successor needs to do in order to maintain Berkshire Hathaway's prestigious reputation. That's next. Warren Buffett is handing over the reins at Berkshire Hathaway, stepping down as CEO for successor Greg Abel. My next guest is a longtime Berkshire Hathaway shareholder who has a few key actions that Abel will need to take to maintain the firm's reputation. That's Bill Stone, the Glenview Trust Company Chief Investment Officer. He's with me now. Bill, it's great to see you. Obviously, nobody expects Greg Abel to be Warren Buffett, right? It's more just a question of how to push the company into the next phase. So let's kind of take it thing by thing, what you think that he needs to do. What's sort of job one here for Greg Abel?
I think you hit it the first maybe thing on the head, which is don't try and be Warren Buffett, following the greatest of all time, and certainly, throw Charlie Munger in the greatest duo of all time. Trying to beat them at their game, so to speak, is probably not the right thing. It's also a different company that it was when it started. It was a failing textile company, and they turned it into a massive, successful conglomerate. We now have a massive, successful conglomerate. So I think it leaves you with, I'm just going to essentially take right from what Warren Buffett has laid out, which is how he would really judge management if he was on the outside, which is watch for them to grow operating earnings over time, Secondly, decrease share count. And he's got a couple caveats on that. You want to do it when it's the right time to do it. Buy shares when it's below intrinsic value, so you're not diluting shareholder wealth. Also, if you buy those shares in, you're growing operating earnings per share at an even faster rate. And last but not least is look out for big opportunities. And that is really two things about that. One is Berkshire Hathaway is so big now that you have to find bigger opportunities to move the needle. Two is they have the balance sheet and $380 billion in cash. So they're one of the few, or, amongst the few that, especially when times are tough, can actually take advantage of those. And I think if you looked back at Buffett and Munger's track record, a few very good decisions was the majority of the great performance. Now, I will say they avoided making very many disastrous decisions, certainly made no large scale disastrous decisions. So that's also an important part of it.
Well, and I guess that's then my next question about Greg Abel is it a matter of more of avoiding mistakes and sort of steering the ship than it is sort of finding those big investments and big bets to make?
Yeah, I mean, I think you're probably right that it's tilted a little bit toward the, maybe I'd say toward managing it more, managing the conglomerate more, certainly more than Buffett and Munger did, which was frankly very little because they didn't enjoy doing that. And then secondly, you really can't force the opportunities. You have to, find them along the way. That certainly is a major part of it, to grow and to find opportunities. But you're probably right that some things have maybe moved more to the forefront.
And when it comes to managing too, I think we spoke to a guest yesterday who said Greg Abel actually, his management skills, to your point, the Buffett and Munger didn't maybe love that part as much, that his management skills might be better or that he can bring some upside in that way.
I actually absolutely think so. That's probably part of my first statement, which is don't try and be Warren Buffett. Mm-hmm. You can actually bring a lot of value. And I think we've seen some of it already, frankly, before he's even taken the reins around, running some of the businesses a bit better. He's done, some nice, or been part of really turning around or improving the railroad, Burlington Northern Santa Fe, gotten the right people involved in the turnaround in Geico, which was extremely important to the overall firm. So I actually think it's paid a lot of dividends. And to your point, could Munger and Buffett have been very good managers? They may have. They just decided they didn't want to do it. They prefer to spend their time looking for opportunities and just let other people manage the businesses. There probably is, and I think we've seen it already, some real opportunity to add some professional management and skills in that part that I think Greg seems to bring to the table.
And Bill, as I mentioned at the beginning, you were a long-time sort of student of Buffett and Berkshire shareholder. And I wonder kind of how his sort of lessons have filtered down into your investing.
Yeah, I think so. Personally, so I was at Salomon Brothers when he took over and saved the firm. So it meant a lot to me. So I think one thing I always think of, my family didn't come from the business, but so I kind of got exposed to it through Gordon Gekko and Liar's Poker by Michael Lewis. And I would say, one of the things is, you don't have to be like, I'll say those villains or whatever. Shouldn't maybe say that about my coworkers at Salomon Brothers, but not all of them. But at least I think you can act a bit differently. I think the next part is just really quite amazing that he viewed it as a duty to gather more wealth, but really just in the end to give it all away to society. And I think that's some really, I think, touching parts of it. When you go to the more investment side, I think he's been amazing in getting Benjamin Graham's ideas out there, where you just say stocks aren't pieces of paper to us or to me. They are really looking at a company, and that's how I think about them. And, that was a big part of my change to thinking of it that way. And lastly is kind of the thing we all, as value investors, think about is the margin of safety. Can I buy this with enough margin of safety that if I made a mistake in my analysis, I don't have a catastrophe on my hands? That's a big part of it. And it really gets to my, or things he said, which I certainly believe, which is all investing is value investing. So while we in the industry kind of break things between value and growth, the fact is what you pay for something, whether it's a company that's growing earnings fast or not, matters.
And Bill, finally, I mentioned presumably you're a Berkshire Hathaway shareholder. Any plans to change your strategy vis-a-vis the shares, or you in it here and you're going to watch what Greg Abel does?
Yeah, so I'll say I'm a personal shareholder since 1999, and we at the firm own it on behalf of clients as well. There's no plans at this time. I mean, certainly, I'll just tell you, I gave you my lens of how I'll look at it. It's exactly how Buffett laid it out. As long as I think they're going to continue to go down that path, to me, there's no reason to sell it, especially with the kind of downside risk that you have in it, which I think is very low relative, or catastrophe risk you have in it relative to most companies. So no, I think yes, you have to monitor it. Probably have to monitor it maybe a little closer than I used to when you had Warren Buffett. But I'm looking forward to learning what Greg Abel can do over time, and I'll be back in Omaha in May as usual.
Sounds good. We'll talk to you then, I'm sure. Bill, appreciate it. Much more markets action coming up. Stay tuned. You're watching Market Catalysts.
Welcome back to Yahoo Finance. I'm Brooke DePalma. We're live at the NASDAQ here in Times Square. Let's get a quick check on the latest market action. We're about 2 hours into today's trading session. We're seeing all three major indices in the red at this very moment. The Dow trying to gain some momentum or regain some momentum that it saw at the open. It's currently flat, down about 0.07%. The S&P 500 also moving lower, down even more, down about 0.6%. But the NASDAQ really leading the downward momentum this morning, down about 1%. And this comes after we've seen this downward momentum over the past few days as we make our way towards this close. And also keep in mind, year to date, the NASDAQ is up about 18.5%. Let's take a closer look at what exactly is driving that. First, I want to go to software stocks, because what we're seeing there is mostly in the green. We are seeing Oracle, though, pop out as a loser today, down about 5%. And if we take a look year to date, Oracle has been up dramatically based upon that AI momentum, but now we're seeing some risk within that AI tech rally. Oracle stock is still lower this morning, though, primarily because Blue Owl Capital said that it won't back a $10 billion data center for OpenAI, and that's why we're seeing that downward momentum today, down once again about 4.8% today alone. And that fear over this AI bubble risk, this AI tech momentum that we've seen so far, is really extending into semi stocks as well. We see, a shift lower for NVIDIA, Broadcom, Taiwan Semiconductors, ASML, also AMD also moving lower today as well. And these ones, again, are the stocks that we've seen such momentum year to date that now as we make our way towards the end of this year, there's this fear, this worry around the AI trade currently. And once again, that's why you're seeing intraday trading most of these stocks in the red, besides this stock, Marvel Technology, moving just a bit higher, as well as Lumentum Holdings also moving just a tad higher. We're taking a broader step back. Let's take a look at the NASDAQ, because we are seeing a bit of a mixed picture there now. I do want to point to one stock that is in the green, and that is Netflix, up about 1.3%. And that's after Warner Brothers shareholders largely said that they were going to reject the bid from Paramount Skydance, meaning that Netflix seems like it has the top offer for Warner Brothers. And so we are seeing that stock moving slightly higher, up about 1%. And keep in mind, when this stock proposed that bid earlier this month, we did see some downward momentum. It's down about 8% over the past 10 days. And in the past month, it's down about 13%. So a bit of a mixed picture here on the NASDAQ, but taking a step back at all three major indices, mostly in the red, as once again, the Dow tries to regain the momentum that it saw earlier this morning. Keep right here on Yahoo Finance. We'll be tracking all the market moves throughout today's trading session.
Now time for some of today's trending tickers. We are watching General Mills, Lennar, and Alphabet. First up, General Mills. The packaged food provider posted second quarter results that beat Street's expectations. The company maintained its annual guidance ranges given persistent consumer pressures. The CEO noted they're seeing consumers purchase more items when they're on sale, noting financial strain. A highlight of the report was positive volume growth in the North American retail segment. In an effort to boost sales, General Mills has lowered prices across roughly 2/3 of its North American retail business. The share's up 3.5%. Next is Lennar, the home builder, reporting adjusted earnings per share for the fourth quarter that missed the average analyst estimate. Its forecast for quarterly home orders also missing estimates. Lennar and other builders are facing increased competition from the resale market, where listings have climbed. Due to that, the company's been leaning heavily on incentives such as discounted mortgage rates to drive sales. Those shares off 6%. And finally, Alphabet. The company's Google division is rolling out a more efficient and affordable version of Gemini 3. Google looking to build on the momentum since the release of its latest AI model, which received widespread praise. Gemini 3 Flash is a lower-cost version of the flagship model designed to help users field more complex queries more quickly. Since the release of Gemini 3, OpenAI has declared, then closed, its code red after it pushed out a new version of its flagship GPT-5 model. The Alphabet shares, however, are lower along with the broader tech complex today. We got much more markets action coming up. Stay tuned. You're watching Market Catalysts. The November jobs report showing payrolls rising by 64,000. Still, the unemployment rate ticked up for a fourth straight month, pointing to some underlying weakness in the labor market. Yahoo Finance's Josh Lipton spoke to ZipRecruiter's labor economist about what's ahead.
In terms of what's ahead here, you say employers are preparing for growth, not survival. That sounds relatively positive. What signs, what signals, Nicole, indicate that to you?
So the current data that we got for November shows that there is still a good degree of stagnation happening in the labor market. There is pent-up demand to hire, we know from our recent employer reports at ZipRecruiter, but that hasn't been able to translate into actual hiring growth due to a lot of the policy headwinds that businesses are facing with tariffs, inflation, and geopolitical tensions.
Do you see that kind of picking up, though, in 2026, Nicole? Gradual improvement there?
2026 is absolutely going to be defined by gradual pickup in demand for employment. We're not going to see the market snapping back or having any sort of explosive growth. It'll be slow and steady winning the race as we get into 2026.
When you look for that gradual improvement, Nicole, I'm just curious, are there certain industries, certain verticals where you would expect to see that improvement?
Healthcare has remained the backbone of the labor market for all of 2025, and that's absolutely going to carry into 2026, as will skilled trades. This morning we saw construction showing positive gains in employment as well. Both of those industries are really going to be booming in 2026 and beyond, given the demographic setup of the U.S. population, which is aging, and we're seeing older folks stay in their homes longer, leading to more construction and more demand for healthcare in the coming years.
Another trend you call out, I thought this was interesting, fewer degree requirements. What's going on there, Nicole? What explains that trend?
As the U.S. workforce is restructuring and aging, we're seeing a lot of new entrants, younger folks in the workforce who are bucking the trend of pursuing a 4-year college degree. And as we have fewer workers who have the formal education training, we're seeing more folks with more diversified backgrounds entering the labor market. As such, businesses are adapting to these changes in workforce demands and are looking at things like skills-based hiring as opposed to checking the traditional box of college degree, yes or no.
You also talk here about flexibility emerging as a big differentiator for job seekers. What do we mean by that? Flexibility, Nicole, is that location? Is that schedule?
It's a bit of both. After the pandemic, we saw a lot of workers demanding remote work and remote work flexibility. As that's loosened up and most sectors have really returned to some sort of hybrid or in-office environment, we're seeing workers are not willing to let up their schedule and location flexibility to have a little bit more say in how their career looks and how their day-to-day life is able to intersect with their job. And that's a big demand point from a lot of the surveys we've seen with job seekers and new hires recently.
You note here a spike in re-entrants you call out, so that's people coming back into the labor force. What explains that? And is that a positive sign for the labor market and the economy, Nicole?
So it's a bit of a mixed bag. We're seeing the overall labor force shrinking due to an aging population and a reduction in net immigration. And that's going to create a tighter labor market moving forward, even though that seems far off given the slowdown in labor demand that we're seeing right now. The rise in new entrants is driven partially by the necessity for more workers in the workforce, but also we're seeing a lot of people coming back to the workforce due to economic reasons, economic hardships, and just overall increasing costs that are driving folks out of back into the labor force.
Nicole, we got to talk about AI. You know that. There's concern about its impact on the labor market. You say here, though, scant evidence, you point out, that AI is impacting the labor market at this point. What's your bet, Nicole, that in fact AI won't trigger sort of mass displacement, or is it too soon to say?
Right now, what we're seeing in as far as AI's impact on labor is a restructuring of how certain jobs are done and the tools and resources that workers have access to enable them to work faster or be more productive in certain roles. That's more where we're going to see the bigger impacts in the near term versus a larger restructuring of where jobs are located. We're seeing now the what is being done within jobs is really where AI is having the biggest impact.
Yeah, so if the bet is AI doesn't replace workers, but it does impact how many of us do our jobs, Nicole, I'm just curious, as a labor economist, how you think through that. Are there certain industries that are more vulnerable? Do you think, well, there's certain skill sets people need to train up on if they want to stay competitive in the future?
Absolutely. Upskilling and learning how to adapt to new technology is going to be vital for workers who are looking at a challenging workforce right now where hires are down and unemployment is rising. Being able to upskill and up-level is going to be really important and could be a key differentiator for those who are able to find the jobs and those who are not. What industries are going to be most impacted? You know, I mentioned earlier that healthcare and construction are going to be two sectors where we see a lot of demand. Manual labor and frontline labor, like in those industries, is not going to be impacted by AI in the same way that we see in business and professional services and other industries that are, our typical office roles. That's where we're going to see a lot more kind of dynamic shifts in how work is accomplished.
Nicole, great to have you on the show today. Thank you.
Thanks, Josh.
In just a few weeks, Warren Buffett will no longer be CEO of Berkshire Hathaway, a job he's held for 6 decades. His number 2, Greg Abel, will take the reins. But this isn't a retirement story. Buffett is still chairman of the board. It is, however, a succession moment for one of the most unusual, most successful companies in history. And for anyone who's ever looked at this stock and wondered what it's all about, on today's Stocks in Translation, we are breaking down Berkshire basics. Berkshire is not a normal megacap. It's a holding company with 3 distinct engines. The first is its operating business. These are companies that Berkshire owns outright. They throw off real cash flow year after year, good times and bad, a Buffett staple. Engine number 2 is the Berkshire stock portfolio, which probably gets the most attention. It holds big stakes in many public companies, with Apple as the largest. And despite Warren saying that his favorite holding period is forever, there's a decent amount of trading churn in the portfolio from quarter to quarter, and Buffett has slowly given up control over its stock picking decisions since 2010. Engine number 3, and this is the quirky one, is Berkshire's insurance business, including what's called the float. Insurance companies collect money from premiums first and they pay claims later. And that in-between float money can be invested. That's a structural advantage that many companies do not have, and it helps explain why Berkshire can afford to be patient when others cannot. Now, let's check out a Berkshire stock chart. And here we're comparing Berkshire to the S&P 500 over the last 5 years, which includes several market cycles. And you can see Berkshire's up 120% versus 80% for America's benchmark index. And you can credit the higher return to Berkshire's ability to hold up better during both the 22 bear market and during the post-Liberation Day sell-off earlier this year. And while the rest of the market started soaring in mid-April at the right of the chart, Berkshire has lagged a bit, and many credit the overhang of Buffett's departure, which only means that 2026 could be a defining year for the conglomerate. Now let's take a look inside at the many businesses that make up Berkshire's own mini real economy. Starting with Geico, their insurance business provides a real-time risk on risk pricing across the world. And through its BNSF Railway, it gauges freight, shipping, and industrial demand. And Berkshire Hathaway Energy, not surprisingly, gives a read on the energy markets, including business investment spending and the power grid. In manufacturing, it has Precision Castparts, which provides a window into aerospace and industrial orders and demand. And Berkshire has a bunch of household brands, from Dairy Queen to Fruit of the Loom to Brooks Running Shoes. Along with its McLean Supply Chain Services business, it has many eyes on the health of the consumer. Finally, from services like flight safety, it gets business travel and training insights. So Berkshire doesn't just track the economy, it lives inside it. And then it brings to us that next question: what happens next? As 2026 kicks off with Abel at the helm, we're going to want to pay attention to Berkshire's capital deployment, as this is always the game. When do they move? When do they sit on their hands? Because investors have been wondering for the last decade when Berkshire will shell out cash for a big buyout. Will Greg Abel be just as willing to wait for the fat pitch? Meanwhile, that cash pile sits north of $300 billion, and it is growing. Next up is stock buybacks. Buffett has always been clear. He's only going to buy a stock, including his own, when the price is attractive or wonderful. So watch that closely. Then there's insurance discipline, the quiet engine. If that stays tight, the whole machine stays healthy. And finally, watch the communication tone and listen to that. We might miss the marathon Q&A sessions and watching Buffett hold court for hours like a folksy oracle behind a can of Coca-Cola, but clarity is what matters. And tune in to the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcast. Stay tuned for more market catalysts up next.
SpaceX has told its employees it's entering a regulatory quiet period, moving the rocket and satellite maker a step closer to an IPO that could be slated for 2026. This according to a report from Bloomberg. For more on what a potential SpaceX IPO means for other space companies looking to go public, as well as just the general landscape for next year, I'm joined here on set by Chad Anderson, Space Capital founder and CEO. He's also the author of The Space Economy. Good to see you.
Yeah, great to be here.
So I'm so curious about SpaceX and kind of like whether it sucks the air out of the room for other types of space investment or creates more of a halo effect for space investment.
I think it's definitely the latter. This is really exciting news. It's still uncertain, but we'll see what happens. But if they do, I think this is going to set a new benchmark. It's going to reprice a lot of assets throughout the category. I think it's going to show what can be done. And I think it's going to kick off a wave of new listings. So this could be really exciting. And then from our perspective as private market investors in early companies, we're really excited to see what happens when these founders get some liquidity who own stock options and shares. And they go on now and they're freed from the shackles of working at big companies. They can go and think about what they want to do, start their own thing. So we expect that this is going to increase the SpaceX mafia. I mean, a few years ago, it was, we were tracking 45 companies or something like that of SpaceX alumni that had gone on and founded new companies. It's now up to, closer to 200, and we'll see what happens with this liquidity event. But for us, this is, SpaceX is the apex player. They're 10 years ahead of anybody else. They've been setting the benchmark all along. Now this sort of moment, we'll see what happens, but it could really catalyze a lot of activity.
On the flip side, if they are so far ahead of everyone else and then their numbers are public, does that then mean that some of the other players, particularly in the public markets who also their numbers are public, like that they're disadvantaged if they're not in the same place as SpaceX is?
Well, that's a really interesting point. So I think SpaceX has stayed private for so long and they've been so in demand. this is the hottest stock in the private markets.
Right.
Everyone is vying to get access to SpaceX. And I think it's really sort of difficult when you've got that much interest and that many investors to sort of keep things quiet. So, you see throughout the news that there's a lot of information that's out there
Right.
on what their performance looks like, right? So it's so that's sort of cat's out of the bag
So it
already.
wouldn't necessarily change the dynamic.
Yeah, I think so. And so you see, what are the numbers, 13 last year, 15 this year. You start to think the growth is not parabolic their growth is not parabolic. But they are cash flow positive, and they have been buying back shares, right? So I think what this would do is really give them sort of a large cash infusion to go after some of their long-term missions to get to Mars, to build data centers in orbit, to fund that and really have a big cash infusion to basically speed things up and go faster.
And one of those is also Starship is one of the projects that they're working on. So how important is that, and what's the timeline for something like that?
Super important. So Starship is a next generation massive vehicle. We've never had anything of this size. So if 2025 was the year of launch frequency, we launched almost every day, one launch per day, right? And that launch cadence is increasing. 2026 is going to be about mass. Starship is a massive vehicle. It is going to be fully reusable, which means that both the first stage of the rocket and the second stage both can land and be refueled and stacked and launched again, more like operational commercial airlines, which is really exciting because that is going to, it promises to deliver another step change in order of magnitude, further reduction in launch costs, which really will do a lot to the halo effect, comment, to really stimulate growth in this category. But at the same time, that vehicle is necessary to launch these next generation Starlink satellites, the V3 satellites that they have already designed, and they're just waiting for a vehicle that can carry them. Their data centers in orbit that they're now talking about in conjunction with this potential IPO requires Starship to be able to launch these things, right? So this is a linchpin. It's critical to their strategy, and it's also critical to take the space economy to the next level.
Another thing that you're watching closely going into next year is geointelligence and defense. Yeah. Those are kind of some themes within space. So what should we be watching for there?
Yeah, kind of just thinking about the convergence of AI and space in totality, right? So we talked a little bit about orbital data centers. Everyone seems to be talking about that now.
Yeah.
Starship and Blue Origin's next generation vehicles too are going to allow us to launch new infrastructure that we couldn't do before, like orbital data centers and some other things. So that's really interesting on the AI front, and also with regards to geospatial intelligence. So if GPS is the dot on the map, geospatial intelligence is the map. This is digital information layered on top of the physical world. A lot of that comes from the global intelligence comes from satellites and different sensor types that are feeding into this really robust, rich data set about what's going on the surface of our planet. That's too much data for humans to comb through. So AI has come along at just the right time to basically help us parse through that and make sense of that, derive useful insights from that. And this is a huge area of growth. We're seeing what we call world models. So everyone's familiar with LLMs and what's going on there, but those aren't really good at helping us to understand and navigate the physical world. So there's a lot of work going on right now in geospatial embeddings, basically embedding the data to have the right geospatial information, coordinates, positioning data, rich layers of data to basically help you now use AI to make sense of the physical world, right? Not just language.
Right.
So this is a huge area of opportunity. A lot of demand is being driven by defense and intelligence communities, but then also there's massive consumer and enterprise applications as well.
Very cool. All right, Chad, we got to leave it there. Thank you so much. Appreciate it. And that's it for Market Catalyst. I'm Julie Hyman. Thanks for watching. More Yahoo Finance is coming up.